Welcome to The Waters Between, a podcast about connection, community, and the power of giving in the Waccamaw region of South Carolina. I'm Mike Mancuso, the president and CEO of the Waccamaw Community Foundation, and excited to be your host as we navigate philanthropy in the waters between. The name Waccamaw comes from the Waccamaw Indian people, the original stewards of this land and water. The word is believed to mean both coming and going waters, and between the waters, a reflection of the rivers and the tides that shape not only our geography, but our way of life. At the Waccamaw Community Foundation, we believe philanthropy should flow just like these waters, connecting people and places, bridging needs and resources, and sustaining our communities for generations to come. This podcast flows from that mission. In each episode, we'll dive into the stories of local nonprofits, community leaders, and everyday people who are making a difference through giving, service, and collaboration. Whether you're a donor, a volunteer, or just someone who cares about the place we call home, we invite you to join us as we explore the waters between. Welcome to this special edition of the Waters Between podcast. I'm your host, Mike Mancuso from the Waccamaw Community Foundation, and we're glad to have you with us today. So we really want to talk a little bit about a topic that affects all of us and all of our communities, and that is really about life planning and also your legacy planning. And we're happy to have attorney Alan Jeffcoat with us today to kind of walk us through some of the steps that you may want to consider as you start to think about planning for life and legacy. Alan, thank you for being with us today.
You're welcome. I'm looking forward to it.
Thank you. So, Alan, tell us a little bit about yourself and your practice, what you do as an estate attorney.
I practice in the Grand Strand area of Horry County and a little bit into Brunswick County, North Carolina. For our purposes, it's a lot of wills, trusts, and probate, and just advising families about planning in all sorts of ways.
Okay. So tell me the one thing, I talk to a lot of folks at the foundation, and a lot of folks continue to put off that so important planning. What are the barriers that kind of keep people away from doing that planning early?
I think a couple of things happen. One is they think they're immortal. They don't think they're ever going to be disabled. They don't think they're ever going to have Alzheimer's. So everything gets kicked down the road until some life event happens and they realize, I need to catch up real quick. That's what I think happens with most folks. I'm a procrastinator also. So if you think it's a tougher sell than it is, then you'll go with the easy route, which is to do nothing. Right. And down the line, that hurts your family.
Yeah. So tell me a little bit more about that. So, not doing that planning, what are some of the pitfalls that can happen that really cause issues when events happen?
One of them, you've got a death situation and then you've got a lifetime situation, but one of them is you slowly develop an Alzheimer's or dementia situation. And at some point you are too late to make the changes you need. Or if there's been a major life event, a family problem, a lot of times it's your beneficiaries, family members that may become disabled themselves, mm-hmm. and you haven't done any planning for them. Yeah. There's just so many things you can do to make this situation easier. And it's once you get in and start talking about it, it's not that hard.
Okay. Well, and I know, having worked with you in the past on a couple of estates, not having that planning leads to a very long, drawn-out process for the remaining family. Is that correct?
It's agonizing for the remaining family, and legal expenses mount up if you haven't done the right kind of planning. It's a way of getting everything done now, but keep it flexible because people's families change, mm-hmm. needs change, And as long as you have documents that are adaptable, that's why we do it now.
All right. Well, thank you, Alan, for being here and helping us walk through these steps. So, Alan, let's talk a little bit about planning while we're alive and living. What are those things, especially in South Carolina, and also because we cross over a little bit North Carolina here, what are those things that people need to be really focused on?
In both states, North and South Carolina, and in most states, it's the same question each time. There's a question of what happens if I get sick and I'm mentally incompetent, I can't make my own decisions. Who can make medical decisions for me? There's also another kind of power of attorney, which is important for finances. What happens if it's not convenient, or I'm absent, or I'm sick? Who makes my financial decisions? And that's sort of the first two things to look at. Okay. And then the will and trust combination, of course, just deals with death issues, and hopefully something after your lifetime that lives on.
Okay. So, Alan, what are the two power of attorneys that you've just discussed, and can you give us a little detail about each?
So, your healthcare power of attorney is a state form. It is a legal document. It does not come into existence once you sign it. It does not come into existence until a medical provider, a doctor, says that you're mentally incompetent. So as long as you can talk to your doctor and make sense, you still make your medical decisions. This document covers what happens if you are unconscious or you're mentally incompetent. Think Alzheimer's or stroke or other kinds of mental disability. In that case, this document steps in and says, this is who's going to make my medical decisions, all my medical decisions. The first could be the first part of the document. It's sort of a schizophrenic document. It gives somebody the power to make all your medical decisions if you're mentally incompetent. And it goes through a number of fill-in-the-blank, yes or no kinds of questions. Then at the end, the legislature took the old living will questions, the end-of-life questions, I call them the pull-the-plug questions, to deal with death with dignity under our system. And those are questions about ventilators and respirators and tube feeding and all of that. They're at the end of the document, and you have several choices. The legislature's already written the choices down. Mm-hmm. You can make some adjustments to that, but it's a very flexible form. But again, it deals with medical decision-making, not financial and other kinds.
So it's, if I understand this correctly, kind of in layman's terms, this is the document that allows you to put your wants and desires down if those decisions have to be made on your behalf.
Yes. And if you don't have that document and something happens, a triggering event, disability or stroke or anything, mm-hmm. then it gets a little bit messy, because then there's a question of who makes the decisions, doctors or the court or however, right. Things you just generally don't want to get into. Right. It largely, the second half of the document largely replaces what we call the living will, mm-hmm. which is a slang document, and we can talk about that as well. But
all right. And then the other type of power of attorney that you wanted to cover.
That power of attorney I get preachy about. I think it's a very important document. It's who makes your overall decisions, everything from legal to financial to real estate. Importantly in that, you also have the ability to have a gift-making power. That is the power of the person that you trust to continue making gifts of your property to charity or family members or whatever, mm-hmm. even if you're too disabled to make that decision.
Okay. Well, two important documents to get things started with. So the next topic is the living will. And you kind of alluded to this earlier, that in South Carolina, you may not need one versus a different type of power of attorney. So tell me a little bit more about the living will and when you really need to consider using that document.
Sure. The name living will is not accurate, but that's what everybody calls it. The legal name is a declaration of a desire for natural death. It's called different things in different states, but that's what it is in North Carolina and South Carolina. What it is an opportunity for you to say at the end of your life how you want two things handled. The first is, and again, this is if you're in a state of permanent unconsciousness or you're in a terminal condition, only that's what this is for. And you answer two questions in that document. How do you feel about extraordinary means of life support? Ventilators, respirators, extraordinary things like that. A second question is, how do you feel about tube feeding, artificial food and water? That's all it covers. It does not cover questions of, well, I'm not dying. What do I feel about who's making my other medical decisions? Say I've got Alzheimer's or a stroke, or I've been in a car accident, or I've got some other illness, and I need somebody else to make medical decisions. That's not covered by the living will either. That's covered by the healthcare power of attorney, which we can talk about.
So, Alan, in the first segment, we talked a little bit about healthcare power of attorney and now the living will. Tell me a little bit more about why I would want one or the other or both.
We still have both forms in South Carolina, healthcare power of attorney and the living will. Both of them are created by the legislature. We have both of them in North Carolina, for example. In South Carolina, there are a few issues with the living will that lead people sometimes to just go straight with the healthcare power of attorney, because the same questions that are in a living will are at the end of the healthcare power of attorney. But there might be situations where someone is not yet comfortable in doing a healthcare power of attorney and turning over decision-making on all of their medical things. But they still want to have something said about ventilators, respirators, tube feeding, and all that. That's where the living will can come in and be useful. In North Carolina, we routinely do both documents. In South Carolina, I almost never do the living will anymore because of the issues with it. But it's available in South Carolina to anybody. It's just you're missing an opportunity to do things right.
Okay. Well, thank you. And again, I think this discussion between these two topics alone tells us how important it is for an individual and a family to sit down with an attorney and really have this discussion in great detail. So thank you. I appreciate you sharing your insights. So our next topic today is how assets transfer upon death. And Alan, kind of help walk us through this. When someone passes away, how do assets move? And can you explain the three main ways assets move after death?
Most of the time, it's under your will or something like a will. If you're using a will trust combination, that's number one. However you've designated property to go in your will. Second is what happens if you have beneficiary designations on retirement plans, life insurance, annuities. It's done not through the will, doesn't involve probate, but that's beneficiary designation. It's called non-probate assets. Mm-hmm. The third way is what we call by operation of law. That means things like joint accounts. If you have, in the case of your house, for example, your home, there's two ways that a husband and wife can, in South Carolina and North Carolina, can set that up. So on the first death, it just automatically goes to the survivor. But you have to make that choice. If you don't, and you leave it as two names on the same deed or whatever, then half of it's going to go through probate and half will still be owned by the survivor.
So if I get this straight, again, you need to sit down with your attorney and talk about this process. And then it sounds like you need to review things like your 401ks, your retirement plans, annuities, also how your titles are written so that your attorney can direct you to make sure those are done correctly.
Yes. And even mundane things like car titles can mess people up. We've got some opportunities in South Carolina to set up cars and vehicles and all that in what would basically be right of survivorship way, so that a car doesn't require you to go to probate if it's done properly.
All right.
Things like that.
So I just want to touch on this. So you've mentioned probate a couple times. And it sounds like, at least in the things that I've touched in my career, you want to avoid probate. Tell us just a little bit about probate.
Probate is, I think the dangers of probate are overblown largely.
Okay.
If you read the AARP magazine, it's written for people in California, New York, Florida, where most people live nowadays. Those happen to be high probate cost states. South Carolina is not one of those. North Carolina is not one of those. So in those other states, the high probate cost states, all the literature says put everything in a trust, avoid probate. South Carolina, that doesn't apply.
Yep.
So
Great to know.
I tell people, you can pay me to do a trust now to avoid probate, but you'll never save enough money to reimburse yourself for legal fees. Okay. If your estate gets above about $5 million, it's probably worth looking at it.
Okay.
But it doesn't save you anything in the way of taxes to do it either way, with a trust or not. That type of thing. But probate is the process that says, it's the only process you have that the court will say, that is that person's last will and testament. And since the will says this, I'm appointing this person as the executor of the estate. If you don't go through probate and do that, you can't have those results. And sometimes that's pretty important.
Okay. Well, it's good to know. Thank you. I appreciate the clarification. Let's talk a little bit more about the will versus the trust. You talked about that in the earlier segment. Can you give us kind of some more specifics about what those two documents are and how they work?
Sure. The average person's estate planning is always going to include a will. Sometimes it includes a trust on the side. If you have your entire estate plan through your trust, through a revocable trust, you're still going to have a will that says anything I own that I've forgotten about goes to the trust when I die. So those work together in that way. But a lot of times a trust is used to do the guts of the estate plan. And the will doesn't say much other than this is going to be my executor and all my property goes to the trust, and then you have to look at it to see where all the things are going to go. Different people need different arrangements, which is why you want to look at flexibility of this. The trust is a private document. It does not show up in the probate court. Some people that are concerned about privacy use that as the reason to do a trust as opposed to putting all the documents in their provisions in the will. You can do in the trust anything you would normally put in a will, and vice versa. They can work together. You can do a trust to avoid the cost of probate, but it's fairly complicated to get that done because once you do the trust, you've got to transfer assets over to it. Mm-hmm. So that's one of the reasons. a trust can be very useful when you have disabled beneficiaries, or you have beneficiaries that are disabled and are receiving government benefits that would be disqualified if they just got an inheritance. There's ways of working around that so that you can have your cake and eat it too. The beneficiary still has the inheritance set aside for them in a way, though, that doesn't knock out your disability benefits.
So again, I think, as I'm listening to all this great information, it's so important that the individual family, and people sit down with the attorney to really lay out all of the intricacies of beneficiaries and assets in the estate to figure out what document to use in this process.
Yes. The difference might be in terms of flexibility, in terms of lasting longer than your lifetime, and your death. The trust may be a bit of an advantage there. Okay. When we get into charitable planning or disability planning for spouses or beneficiaries, trust can be more advantageous. All right. But it does add usually some cost to the lawyer bill at the time you do all of this.
Okay. Well, good to know. Thank you. I appreciate that information. So, Alan, you one of the things that kind of crossed my mind is we've got a lot of folks that have moved into our market from all across the country. And a lot of folks still own assets outside of the state of South Carolina. So how does that play into this planning as they're sitting down doing a will and a trust?
Good question. The main concept is your estate plan is going to be based in South Carolina if you live here, or North Carolina if you live there. And this question comes up mainly with regard to real estate, because other assets follow you when you move. Financial assets, they move with you, stocks and bonds. But with real estate, we constantly have clients here who have a home in North Carolina mountains or in Virginia or out west somewhere. And oh my gosh, we've got to have a probate in 2 states. So we get around that by just having a simple, stripped down, revocable trust associated with their will here. And that's all we do at this end. Then we get the lawyer in North Carolina to do a simple deed to the real estate from yourself into your trust that you totally control. And then when death occurs, that probate doesn't happen in North Carolina or wherever. Right. It's just here. It saves a fair amount of expense and heartache, and it happens all the time.
Thank you for that clarification. I think that's probably one of the big issues for a lot of folks here, because most of us are transplants. So our next topic, Alan, is joint ownership. It sounds simple, but it also sounds like it might be able to cause real problems. So if you could for us, kind of explain joint ownership in South Carolina, especially around tenants in common versus joint tenancy.
Sure. The question comes up most often with regard to real estate, but it happens with other assets. In South Carolina, there's 2 ways that 2 people can own real estate together. One is tenants in common, which is the simple way. That is, both names are on the deed. The other way is joint tenants with right of survivorship. It's also simple. Both names are on the deed. The only difference between them is what happens on the death of the first one. And the second way that I mentioned, which is joint tenants with right of survivorship, when that happens, it's like a joint bank account. The first guy dies, it automatically passes to the survivor, does not go through probate. Your will doesn't control it. It just happens. The other way, which is just tenants in common, which is just does not have the survivorship language in the deed, then half of the property is going to go through probate and go out under the will if there is a will. The other half is just held by the survivor. That is a potential problem if you've got debts of the one who died first. And the way with right of survivorship on death, it just passes without dealing with, in most cases, debts of the person who died.
All right.
So
again, so important that you sit down and explain this to your attorney so that they can guide you directly and avoid those issues.
And it's an easy fix. Frequently when we have people come in, we'll look at their deed to their house first before we get too far and say, well, you've got it this way. Do you want to keep it that way? And most of them said, no, I thought it was going to go right of survivorship. Well, that's not what you have in your deed.
Yep.
So we just do a deed from yourselves to yourselves and solve the problem.
So it's really important to allow your attorney to review all of those documents.
Sure.
Yeah, during the process. All right. Thank you, Alan. I appreciate the clarification. So our next topic, Alan, is beneficiary designations, and understanding how that works and the importance of updating beneficiaries very often.
So this happens often in my practice where people have what we call, well, non-probate assets, life insurance, annuities, retirement plans. All those are matters of contract between you and the company that's managing whatever it is. Mm-hmm. And then you get into what does your will or your trust say for beneficiaries of your estate. And most people try to coordinate those so that they come out the same way, your loved ones are covered. But things change as you go through life. There's divorces, there's disabilities, there's reasons why you don't want this person to get property in this certain form. And then you come into the lawyer and change what you need to, and you think you're covered, and then you forget about all these beneficiary designations that don't have anything to do with your will. And in some cases, people's wealth is largely in these non-probate assets. So you've changed your wills and you think you've done what you need to, and all of a sudden it does not work. It's nowhere near what you had planned. And those are easy fixes. Usually the lawyer is not involved in doing the change, but the lawyer should be involved in asking the questions and making you think about, is this right or not? And you'll have a lot of times divorced kids that you wanted to remember your kid, and you used to like the in-law, and now there's a divorce or there's problems, health problems, and you just don't want it to happen. So always just check it every couple of 3 years.
Okay. That was going to be my next question, is how often should you review your beneficiaries?
Anytime there's a life event that happens, something in the family, there's no time frame for that. But otherwise, every 3 to 5 years, I would say look at it.
Okay. All right.
Or if you have one insurance policy and you wanted to get a different one or want to make it, well, then go make sure that the new one is done the right way.
All right. Good advice for sure. Thank you, Alan. So, Alan, the next thing we want to talk about a little bit is tax considerations. And without getting too technical, tax stuff kind of makes my head go boom. Can you tell us a little bit about what families need to be aware of, especially when they're doing their legacy planning?
Nowadays, most of my clients don't have to worry about the estate tax, state or federal. Well, South Carolina's never had one. The federal one, the exemption now is $15 million for an individual and $30 million for a married couple. So that's not the big issue anymore. The big issue is the capital gains tax and how that filters itself into your estate planning. People used to not worry about it, but now in this market, real estate prices have gone up so much that capital gains tax might hit people on the sale of their house that they never thought was a big part of their estate plan. So that's what people are looking at. You've got the issue of the use of charitable planning, hopefully manage the tax bite, if there is one, or more importantly, add flexibility to their estate plans. The beneficiaries, the people who receive your money under your scenario, don't pay a tax anyway unless it's a retirement plan and they're trying to take money out of it. Then there's a normal kind of income tax. So then the question is, how do you work your charitable planning in with your family planning? And there are ways during lifetime particularly that you can actually increase your disposable income by making charitable donations of these same appreciated assets. One of the things about property that's worth a lot more than you paid for it is if you donate it to charity in the right form, you can transform what is an illiquid piece of real estate worth a lot of money, but it isn't generating much money. You can generate increased money for your family during your lifetime and create a great legacy for charity at the same time.
Well, good tips. And again, so important to be talking to your tax advisor and your attorney in that process. So Alan, one of my favorite topics is charitable bequests. And we do a lot of those at the foundation. Why do charitable bequests play such an important role in estate planning for families?
Well, there are so many opportunities to leverage charity or charitable bequests into, number one, doing something that you would want to have done anyway from your charitable inclinations, or to create something for charity that lives long beyond your lifetime, creates a true legacy that a lot of my clients talk about giving money every year to charity, but it's in and out, it's over with, and it's important to do. But the missing element to those is it's not creating something that's going to live past the time you're here. Right. And that's where the charitable planning becomes pretty important. And like I said in an earlier segment, the ability to transmute illiquid, high-value assets with a big built-in capital gain, which you do through other the foundation doesn't get involved in that part, but is the charitable component of that kind of planning. Right. And that's happening more and more.
Absolutely. I know we work with a lot of donors that have, in their lifetime, decided to move an asset to the foundation, and we can accept that through our land trust if it's a property, as an example. And that helps avoid the capital gains and gives them that value now in a fund at the foundation for their charitable giving. The other thing that I like about the bequest piece of this is once you've established your will and your trust, and we know that at the time of your passing, what's going to come to a fund at the foundation, and the bequest directs us on how we then give those funds out to charity. If you have changes during your lifetime that you would like to make, you just walk in or give us a call and we can make updates to your bequest. And you don't have to go to the attorney and change the will or the trust, which has a cost to it.
Well, I don't really like the idea of depriving the lawyer of his fee, but I personally have a fund like that with the foundation, and if the written directions that the foundation helped me work out change over time, and I may decide I don't want to go to this church anymore. I'm mad at so-and-so, or here's a new opportunity out here, and you don't want to have to go to the lawyer and amend the will and amend the estate plan every time that happens. Yep. It just happens more frequently than you think. And if you've got a donor-advised fund or an endowed fund or something that has just a letter of instruction between you and the foundation, then your will or your trust or whatever just simply says, I leave this part of my estate to the foundation to be administered based on whatever written instructions I've given them.
Yep.
And then that's the end of it as far as the lawyer and the will and all that's concerned. But it's infinitely flexible when you change your mind.
Right. And one example I'll use, I had a donor recently who's leaving a portion of their estate into a fund, and that fund is going to, by their bequest instructions to us, will pay annually out of that fund to their church. And it defines exactly what they want, where they want those funds to go. And in this case, not only was there a gift to the church, but there were also gifts to the missions in the church. Very specific, so that when we receive those funds, we can then inform that receiving organization, oh, by the way, this is where these funds need to go. And we manage that and keep that into perpetuity. And I think the really cool thing about it is I think about myself as a part of my church today and what I give to my church today. When I pass, that's a loss to the work in that church. And through bequest and through my estate planning, I can ensure that my giving to the church continues into perpetuity.
Yeah, it's a wonderful situation to keep your options open and still provide for some sort of charitable interest.
Alan, the next thing I'd like to ask you about, and this is, I've always been kind of fascinated by the abilities of IRAs to be used in the charitable sector. But they also come with some acronyms that maybe folks don't understand. So there's the QCD and the MRD. Yes. Can you help explain a little bit of that and what those are for and how they can benefit them?
Yes, the lucky client who has a good-sized IRA or similar retirement plan where there's a significant amount of assets accumulated there. And if you're over a certain age, depending on what year you're in your 70s, you start being required to distribute out of that IRA or retirement plan a minimum percentage based on your life expectancy every year. And when that comes out, it is taxable to you. So Uncle Sam gets his money back for all the deferrals that he's done over time. So that happens whether you want it or not. And you're required to take it out and pay taxes on it. If you don't, there's all kinds of penalties. So if you have a charitable interest, what you're limited to is taking your IRA minimum distribution out, pay taxes on it, and then make your charitable gifts to whoever you want to have as your charitable beneficiary. And you'd get a tax deduction for that, although it doesn't always work even Steven there. So the law now says, and this is relatively new, that you can direct that the minimum required distribution out of your IRA, instead of coming to you personally, goes straight to the charity, bypassing the Uncle Sam getting his hands on it coming out, and then you have to deal with is a deduction legitimate for the charitable gift. It's the greatest thing since sliced bread as far as I can tell, and again, it's pretty recent. All you have to do, and it depends on the company that handles your retirement plan, go to them and say, this is what I want to do. The one that I am familiar with, the one that I use, they will actually take a list from me of the charities that we want to give to that year, and they will have the check cut directly, and that's the end of it. Mm-hmm. Now, you don't get the charitable deduction in your personal tax return, but that's because you avoided the income tax on getting it out of the retirement plan. It's very nice, generally very inexpensive. If it shouldn't, in most cases, cost anything.
Mm. Well, and I can use an example too. I've had a donor just recently in that same situation where they were going to be required to take their minimum distributions, and they had made the decision to actually set up a scholarship fund at the foundation. made the foundation its beneficiary of their 401k. But as those minimum distributions started in this current state, they started to direct them to that scholarship fund. So ultimately, all those funds come to the scholarship at their direction. But it was a great tool for them to get the scholarship started now.
The other thing that I didn't mention a second ago is if you utilize what we talked about, which is diverting the required minimum distribution out of your hands and into the charitable hands, you can have your cake and eat it too, and do that and still, in most cases, use the standard deduction on your income taxes. And in some cases, I mean, it's not an actual deduction. It's a moving of numbers around on your tax returns. So you can actually preserve your standard deduction, even though you're effectively making large gifts to charity in many cases. For people with big IRAs, the amount of money that has to come off of those every year, whether you want it or not, is a large number, and it's growing.
All right. So again, good reason to talk to your tax consultant, your accountant, and your attorney in those processes. Thank you, Alan. I appreciate that.
Sure.
That's part of the discussion. So, Alan, I want to talk a little bit about the role of the Community Foundation in this process, specifically the Waccamaw Community Foundation. We are here to really serve our community directly, both Horry and Georgetown County and the Waccamaw region here in South Carolina. We are a 501c3 nonprofit charity, and so we work with donors here in the market to help them create legacies that pay well after they're gone from us. And I look over time and look at what endowments have done for a number of institutions. And, I go back to my old hometown in Pennsylvania, and we had a gentleman by the name of Buell, who was big in the steel industry for a very long time, right alongside the Carnegies, and left some beautiful real estate to the city as it became a city park. And they also left a endowment in place that takes care of that park into perpetuity. And so they've left this wonderful gift of land, but also the ways to maintain it for generations to come. And that's what we at the Waccamaw Community Foundation love about what we do here is we help folks with that long-term giving plan so that they're giving well past their lifetime. So what I want to ask you about is really the role of the Community Foundation in this legacy process, the estate process as people are building out their plans. And how we can come alongside as a partner in their philanthropic giving in that process.
Well, once again, I'm talking about ways to minimize legal fees, which I don't like, but I'm not being serious. But the beauty of the role of the Community Foundation in planning is that my client can sit with competent people at the foundation, and I've had a lot of experience with them, and talk their way through what their concerns are, what their wishes are, what they want to have happen after they pass, what do they want to have happen now, all of that without sitting with a lawyer or other professional. Now, there may be times when they need to go see their accountant to talk about, can I do this, can I do that? But it becomes a key element in crystallizing the thinking of their client, my client, helping them say, well, do you think about this? Do you think about that? What's your number one desire? Who are your family members? What challenges do you have there? A lot of that can be done in a non-professional, it is professional, but you don't have to have a lawyer sitting there going through all that, billing by the hour, all of that. It's a very useful part of the estate planning. And it's the assurance that after you're gone, it's going to be well managed and in a way that's consistent with what your goals are. And there's no other element that I know of that does that. That's really why I got involved with the foundation myself, was I kept sending clients down to them to have that conversation. And then next thing I knew, a few months later, they're back saying, I've got it all worked out. I want X percent of my estate going to the community foundation, and they already know how it's going to be handled. And that's beautiful from my standpoint to see a client that happy.
Well, and I appreciate that input. I think it's so important for our viewers to understand that at the foundation, our number one goal is really to capture the donor intent, document it so that generations from now that we still know exactly what their intent was and how they wanted their gift to be managed, where it goes, how much it goes into the future. And I have this conversation very regularly with donors about perpetuity. We often have a tough time thinking about just the time in our lifetime, and to think about literally decades past our passing, being able to still have impact in the community is really what the foundation is all about, and it's the tools that we carry to help people do that. So thank you. I appreciate that a lot. Appreciate your work with the foundation over the years. We wouldn't be where we are today without you, Alan.
Great cause.
So, Alan, thanks for being with us today. I appreciate you sharing your knowledge with our viewers, and hopefully we've given some folks food for thought as they start to think about their estate planning. So to wrap this up, if people do the kind of their homework and get this right, is there one piece of advice you'd like to leave the viewers with in the estate process?
I'd say verse number 1 of this sermon would be, don't put it off. It's easy to get started. It's not that painful. From a lawyer's standpoint, half of my practice probably is educating clients in the opportunities that are out there that they had no idea about. So don't put it off. Second verse would probably be thinking about who's going to make decisions for you if your first choice can't do it. Usually it's your spouse is in there, number one, or if it's a single person, one of your kids is number one. But what happens if that person can't do it? Give me a second choice. Give me a third choice. That's the thing I get into the most when I'm interviewing somebody. Whose judgment do you trust? Doesn't have to be a family member, but it can be. And the bottom line is, it's not that painful if you get started now. It is really painful for your beneficiaries if you haven't done the planning.
All right. Well, thank you, Alan. And again, I appreciate you spending time with us today and helping our viewers understand this process. And hopefully we've spurred some folks to think about it and get things started. Thank you.
Very good.
Thank you for joining us today. I hope you found this interesting and informative, and hope it spurs you to think more about your estate planning in the future. The Waccamaw Community Foundation stands ready to be a partner whenever you're ready to make decisions about your charitable giving. We're here as a resource. Please check us out online at waccamawcf.org, or feel free to call us directly. Again, I'm Mike Mancuso, the President and CEO of the Waccamaw Community Foundation, and we thank you for joining us today.